According to CNBC, 74% of consumers are concerned about a looming recession, and as global markets continue to crash, one of the ways to increase our wealth is to hold companies that consistently deliver dividends in spite of any crisis. Investors can make money from dividend-paying stocks in two different ways: through an increase in the stock price and through dividends made by the company. Many dividend-paying companies are in defensive industries that can withstand economic downturns with less volatility, in addition to offering a steady income. Furthermore, dividend-paying businesses typically have a lot of cash on hand, making them solid businesses with promising long-term performance prospects. We do tons of research about the stock market, and our goal is to help you on your journey to financial freedom so you can live life on your own terms. That being said, here are the 5 best dividend stocks we think may fare well in a recession. If you like this video, make sure to destroy the like and subscribe buttons so you won't miss any of our future content. Make sure to stay till the end, as our last stock pick is our favorite and we think you'll like it too. Now let's get right into the video. First off, we have Newell Brands, Inc. Newell Brands is a leading global consumer goods company with a robust portfolio of well-known brands such as Rubbermaid, Food Saver, Systema, Calphalon, Coleman, Graco, and Sharpie pens. Newell Brands designs, manufactures, sources, and distributes product in the areas of writing instruments, home solutions, tools, baby products, and others. The majority of Newell Brands' clients are big box stores like Walmart, Target, and Staples, which provide office and home supplies. The global footprint of Newell includes about 70 warehouses, 55 regional distribution hubs, and about 55 manufacturing locations. Additionally, it owns about 315 retail outlets, mostly Yankee Candle related. About 300 stores are in the U.S. At the start of the COVID-19 outbreak back in March of 2020, Newell Brands' stock price tanked by roughly 48% from a peak of $20 a share at the beginning of 2020 down to $11 a share in March of the same year. The stock recovered rapidly as the Fed began to pump cash back to the economy. By May of 2021, its stock price had risen 185% from the bottom. Due to the current global macro climate, the stock has plummeted back to COVID lows and could signal a good entry point to accumulate this stock at a sure bargain. Institutions have been gradually reaccumulating this stock at bargain prices. According to Fintel, Psena Investment Management LLC, an institutional investment manager based in New York City, disclosed its ownership of 42,742,989 shares of Newell Brands, Inc. in a 13GA form submitted to the SEC. This amounts to 10.33% of the business. They reported 28,342,422 shares and 6.8% of the firm in its prior filing on January 21, 2020, a rise of 50.81% in shares and an increase in total ownership of 3.67%. What are other large shareholders doing? BlackRock, Inc., the biggest wealth management firm in the world, already owns 54,940,706 shares of Newell, or 13.28% of it. In its prior filing, the firm reported owning 54,045,290 shares, representing an increase of 1.63%. Over the previous quarter, BlackRock increased its portfolio allocation to Newell by 7.65%. State Street Corp. already owns 5.35% of Newell, or 22,123,066 shares. State Street reported owning 21,398,665 shares in its previous filing, an increase of 3.27%. Over the previous quarter, the company increased its portfolio allocation to Newell by 11.40%. Looking into Newell's historical revenue, it booked an average of $9 billion over the past 10 years. From $6 billion in 2012 to $11 billion in 2021. Its operating margin has tightened from 12.5% to 9.7% from 2012 to 2021, with an average rate of 10.3%, yet with an uptrend in revenue, it's only a matter of time before its margins trend back up. Its return on invested capital has averaged 1.6%, largely due to a negative 37.4% return in 2018. Our model suggests that Newell still has room for growth, and our model conservatively estimates 8% annual returns over the next 5 years. With a current dividend yield of 7%, Newell Brands should definitely be part of our top dividend stock picks. Next up, we have Pioneer Natural Resources Co. Pioneer Natural Resources Company is an oil and gas exploration and production company. In the Midland Basin of West Texas, the company searches for, develops, and produces gas, and natural gas liquids, NGLs. The company conducts exploitation and exploration activities in the Strawberry Wolfcamp oil field located in the Midland Basin in West Texas. Pioneer has proven reserves totaling 2.222 billion barrels of oil as of December 31, 2021, of which 44% were crude oil, 30% were natural gas liquids, and 16% were natural gas. A total of 617,000 barrels of oil were produced daily by the company in 2021, of which 61% were petroleum, 23% were natural gas liquids, and 19% were natural gas. Prior to March 2020, Pioneer stock was trading with the range of $120 to $160 a share. When lockdowns began to hit the news, the stock fell by roughly 65% as investors feared that prices of commodities like oil will take a big hit when the economy shuts down. Fast forward to today, the price has recovered well from the lows of March 2020 and has risen by roughly 363% from those levels. Looking into its investment front, although oil and gas may be West Texas's main sources of energy, the region also has access to wind energy. The Midland County Commissioners recently moved action to assist Pioneer Natural Resources in establishing their own wind farm on county property. Pioneer wants to use wind to actually help them run their oil and gas operations on over 25,000 acres of their property, while also aiming to reduce emissions. The county approved a reinvestment zone for the Pioneer Hut Renewable Project recently, which is the first step in enabling the company to submit an application for a tax abatement. Pioneer Hut Wind Energy is an LLC that uses wind power to generate electricity, and they are another step closer to making an impact in Midland. According to Midland County Judge Terry Johnson, they'll be putting in, I believe it's 50-plus windmills south of town on property that Pioneer owns, and that energy that's generated is scheduled to power Pioneer's requirements out there on that ranch. Furthermore, when the project is finished, it will have generated between 4 and 6 permanent jobs in addition to more than 100 construction positions. Pioneer has always been a leader in the economy in the Permian Basin, especially in Midland. Looking into the numbers, Pioneer's revenue grew from $3 billion in 2012 to $18 billion in 2021. That's a 500% increase in revenue in just 10 years. Its operating margin has also increased from 27.6% to 36.5% over the same period. This is outstanding compared to the average 10 to 12% operating margins of profitable companies across any industry. Its return on invested capital averaged 2.2% from 2.2% in 2012 to 9.5% in 2021. Pioneer has an average dividend yield of 8.2% as of today, and it's one of the many factors why we love this stock. Our model predicts that Pioneer stock will have annual returns of 6.1% over the next 5 years. Coming up next is a company most of us love, the Coca-Cola Company. The Coca-Cola Company is a global American beverage company that was established in 1892 and is best known for being the maker of Coca-Cola. The Coca-Cola Company also produces, sells, and markets alcoholic beverages as well as other non-alcoholic beverage concentrates and syrups. Coca-Cola is the largest beverage manufacturer and distributor in the world and one of the largest firms in the United States with more than 2,800 products available in more than 200 countries. The drink Coca-Cola was originated in 1886 by an Atlanta pharmacist, John S. Pemberton, at his Pemberton Chemical Company. Frank Robinson, his bookkeeper, came up with the drink's name and gave it the flowing writing that would later become synonymous with Coca-Cola. Based on cocaine from the coca leaf and caffeine-rich extracts from the cola nut, Pemberton initially promoted his beverage as a cure for the majority of common ills. Shortly thereafter, the cocaine was removed from the Coca-Cola formula around 1903. Pemberton supplied local soda fountains with his syrup, and with the help of advertising, the beverage saw incredible popularity. The Coca-Cola trademark was registered in the U.S. Patent Office in 1893. Before the pandemic hit, Coca-Cola's stock was trading at around $60 a share. This crashed to $36 a share in March 2020, a 40% drawdown from its previous peak as investors feared a global recession brought by the health crisis. Since then, the stock has gradually risen and is now trading above pre-pandemic highs, in spite of the current bear market. Warren Buffett, arguably the best investor of all time, has Coca-Cola on his list of all-time favorites and longest-held positions. In 1988, Berkshire Hathaway began acquiring shares of Coca-Cola Co., and it has since continued to do so. Currently, Berkshire Hathaway holds 400 million shares of Coca-Cola stock, or nearly 8% of the firm, with a staggering market value of $22 billion. Berkshire Hathaway is sitting on enormous gains in the company because the stock was only a few dollars a share when Buffett started buying the business in 1988. In addition, Coke pays out a quarterly dividend of 44 cents, bringing in a total of around $1 billion annually. The same reason Buffett favors every firm he invests in is why he likes Coca-Cola stock, and that is called value. This is meant in two ways. First off, he has a reputation for only investing when the price is right and not a penny more. At the time, Coca-Cola stock had a favorable pricing and an intriguing competitive advantage. Coca-Cola owns nearly 50% of the US soft drink market, so as long as people are drinking soft drinks, Coke will be performing well. Looking into Coca-Cola's numbers, its revenue has averaged $40 billion over the past 10 years. Although this has dropped from $48 billion in 2012 to $39 billion in 2021, its operating margin has steadily increased from 22.4% to 28.6% over the same period. Its return on invested capital has averaged 10.9% from 14.3% in 2012 to 14.8% in 2021, despite several headwinds in the past. No wonder why Coca-Cola has been one of Warren Buffett's favorites for decades now. At its present share price of $60 and a conservative earnings per share predictions of 6% annually, our model projects that Coca-Cola stock will have annual returns of 7.8% over the next 5 years. Next up, we have a company called Coterra Energy, Inc. Coterra Energy, Inc. is an independent oil and gas company that engages in the development, exploration, and production of oil, natural gas, and natural gas liquids in the United States. It primarily focuses on the Marcellus Shale, which occupies around 177,000 net acres in Susquehanna County, Pennsylvania, in the play's dry gas window. The company also owns holdings in Oklahoma's Anadarko Basin, which has about 182,000 net acres, and the Permian Basin, which has about 306,000 net acres. Moreover, it runs collection systems for natural gas and saltwater disposal in Texas. Coterra offers its natural gas for sale to industrial clients, neighborhood distribution firms, oil and gas marketers, significant energy firms, pipeline firms, and power-producing facilities. Looking at the price chart of Coterra, its stock was trading around $20 a share in March 2020 and dropped 35% within the same month due to the intense fear of the global lockdowns. In spite of this drop, Coterra still outperformed its peers when the energy sector dropped 62% within the same period. Coterra recovered gradually from the lows of March 2020 and has risen roughly 110% to today's prices. On the strength of a surge in energy prices, Coterra Energy became one of the most recent oil and gas companies to report huge quarterly profits and increase shareholder returns. Energy prices have reached multi-year highs this year as a result of Western sanctions against major supplier Russia and OPEC Plus's decision to reduce supply in an already constrained market. Coterra promised to increase cash dividends by 5% over the previous quarter and to return approximately a third of its free cash flow to shareholders. Coterra's quarterly earnings increased from $64 million last year to $1.2 billion as a result. Judging Coterra by its numbers, it has booked average revenue of $2 billion over the past 10 years. From $1 billion in 2012 to $3 billion in 2021, that's a 200% revenue growth in just a decade. What's interesting, though, is its operating margin. Historically, profitable companies have an average of 10 to 12% operating margin across any industry. Coterra outperforms this benchmark by having a 25.4% average operating margin for the past 10 years. That's from 21.2% in 2012 to 48.5% in 2021. Its return on capital invested has increased from 4.2% to 12.7%, averaging 5.9% per annum over the same period. Based on this data, our model predicts that Coterra will have conservative annual returns of 11.5% over the next 5 years. Last but definitely not least on our list is a company called BlackRock, Inc. BlackRock, Inc. is the largest investment management firm globally with more than $10 trillion in assets under management as of December 31st, 2021. As a major publicly traded company with a market capitalization of about $112.3 billion, BlackRock provides investment and technology services to both institutional and retail clients around the world. BlackRock provides a range of funds and portfolios that invest in assets like fixed income, money market instruments, and equity. Clients look to BlackRock for access to exchange-traded funds, mutual funds, and investments with a focus on goals connected to retirement income and college savings. The largest global provider of ETFs, the iShares Group, is owned by BlackRock. BlackRock generates the majority of its income from client-paid administrative and investment advice fees. Among BlackRock's major competitors are the Vanguard Group, State Street Corp, SST, and T. Rowe Price Group, Inc., TROW. Before the crash of March 2020, BlackRock's stock was trading at around $572 a share. This sharply dropped to $327, a whopping 43% drawdown from its peak when global lockdowns were imminent. Its price recovered, though, relatively quickly as the Fed began pumping cash to rescue the economy. To put it into perspective, if you've perfectly timed the bottom of March 2020, you'd be sitting at a whopping 120% profit even in the midst of the current bear market. BlackRock surely leads the pack when it comes to investing in future disruptive technologies. Recently, BlackRock has begun to evaluate how the infrastructure supporting the cryptocurrency market may be applied to its regular money management business, which is the most recent indication that well-known fund companies are taking an interest in digital assets. Stephen Cohen, who oversees BlackRock's operations in Europe, the Middle East, and Africa, told Financial News that we're exploring it at the moment. The biggest impact on asset management over time will not be crypto as an asset class, although we can debate back and forth about that. The more interesting discussion is about the technology being developed in the crypto and digital assets world and how that will have an application to the traditional asset management world. Tokenization, in which shares or units in an investment fund are digitally represented and may be sold and recorded on a distributed ledger, is one area the $8 trillion asset manager is investigating. Tokenization is about trying to give more people access to investments. That will be the ultimate goal, said Cohen. There is a valuable opportunity over time for the industry. BlackRock's work on identifying opportunities in the digital assets arena is at the early stages, but has involved discussions with banks, custodians, and pure-play digital assets players. If you've wondered why we've picked BlackRock as our favorite, then we'll show you why. If you'll study the chart, BlackRock has consistently increased its revenue over the past 10 years, from $9 billion in 2012 to $19 billion in 2021. What's more, its operating margin averaged 39% over the same period. That's from 37.7% in 2012 to 38.6% in 2021. This is superb given that on average, profitable companies only keep 10 to 12% of their revenue across any industry. Its return on invested capital has also increased from 7.5% to 13.1% over the same period. Everything looks good when we look at the stock valuation for BlackRock. At its present share price and conservative earnings per share predictions of 8% annually, our model projects that BlackRock stock will have annual returns of 13% over the next 5 years. So there you have it, folks. Those are our 5 best dividend stocks to buy right now. Comment down below your favorite stock pick, and if you enjoyed our content, don't forget to hit the like and subscribe buttons, and we hope you have a truly amazing rest of your day.